Good afternoon, Portland metro area. I'm Jennifer Timm. I'm a licensed real estate agent in Oregon and California. And as a real estate wealth advisor, we help families grow, protect, and transfer generational wealth through real estate. One of our goals is to make sure that you have all the latest, greatest information about what's happening at the national level in the real estate market and the local level. And then we look at the global perspective because that definitely influences or opens up the opportunities that are out there. And we also have a wealth building tip. So let's get started right away with our midweek market brief. And it's December 3rd, 2025. And this is where smart money watches the market. So there, for a change, is good news coming out if we look at the national market. Mortgage rates are holding steady near 6%. The average 30-year fixed mortgage rate sits at 6.23%, near 2025 lows, and definitely down from 6.6% a year ago. Despite expectations for a Fed rate cut next week, markets and experts project little immediate impact. And rates for FHA and jumbo loans show only minor week-to-week changes. So talking about that Fed rate cut. Now, again, not the mortgage rate cut. This is the Fed rate cut. The odds are improving, but market reaction may be muted. The odds of a December 10th Fed rate cut now sit at 88%. They were about 50% last week, driven by mixed economic signals and delayed job data. But even if a cut happens, economists say mortgage rates may not fall sharply, as much of the effect is already priced into our current rates. Home sales and buyer activity begin to stir. This is great news. It means when the market moves, when there's buying and selling, it will hopefully start normalizing. Pending home sales, excuse me, allergies. Pending home sales rose 1.9% in October, with the Midwest leading by 5.3% due to better affordability. Existing home sales are up 1.2% month over month and 1.7% year over year, marking 4 consecutive months of year-over-year gains. Again, good news. Purchase mortgage applications are up 26% year over year, showing signs of renewed buyer confidence. More good news. Buyers offer incentives amid rising inventory. 41% of buyers are cutting prices up from 30% in Q1 to attract buyers as inventory builds. New construction is helping to relieve supply pressure, especially in the South and the Midwest. Affordability is slowly improving. The index rose to 104.5, meaning a median income household now earns more than required to buy a median priced home. Monthly mortgage payments dropped 1.3% year over year and are expected to dip below 30% of household income for the first time since 2022. Income growth is outpacing home price appreciation, easing pressure on buyers, because we know it's all about that affordability when you're looking to buy a home. Multi-generational living is on the rise again. 14% of recent buyers purchased multi-generational homes, primarily driven by affordability, caregiving needs, and adult children returning home. These arrangements are also financially strategic, with more households combining incomes to qualify for home ownership. And then younger buyers are back. More good news. Buyers under 40 now account for 44% of new mortgages, a level not seen since the year 2000. Their return is being fueled by declining rates, modest price growth, and improving job confidence. All round good news. Our mortgage rates back down near recent lows. So they're sitting at 6.23%. This is as of 4 p.m. Eastern Standard Time, 1 p.m. Pacific Standard Time. So mortgage rates improved more noticeably today, and while the average rate isn't quite as low as it was last week, it's fairly close. Rates are based on movement in the bond market. Bonds were most likely to move in response to one or both of today's big economic reports. Oddly enough, most of the bond market improvement was seen overnight before the economic data came out. Nevertheless, the data definitely didn't hurt. Our national smart money insight: the housing market is quietly repositioning for a rebound. With mortgage rates hovering near 6%, income growth outpacing home price gains, and builders cutting deals, savvy buyers and investors are re-entering the market before the spring rush. The smart money isn't waiting for the headlines, it's watching the fundamentals, which are steadily improving. Speaking of headlines, I do want to add in here, it is so important to make sure that you are following a true housing economist. I am not a housing economist, I am a real estate expert, but I follow credible housing economists who have models. They can prove what they're saying, they can justify it, and the proof is in the numbers. So avoid those headlines which are there for entertainment purposes only, saying that prices are going to decrease 50% and we're, entering into another real estate crash. None of the indicators are showing that, and none of the experts that I follow that have models are saying that that's likely to happen. In fact, everyone is saying everything is going to marginally improve. Are we going to see 3% interest rates again? Absolutely not, because if we do, it means we are going through some kind of global catastrophe. And I think we'll all agree we are done with that. We certainly don't want to go back to that, those COVID days. So our local market spotlight, starting with Portland itself, our median list price, 650,000. Price per square foot is up, it's 312. Our inventory is slightly down, it's 1,345, and our median days on market remains at 77, and we remain at a market action index of 39, meaning it's a slight seller's advantage. With nearly half of the listings showing price reductions, buyers have negotiating leverage, even in a slight seller's market. So watch that MAI closely. If it ticks up, it may signal the end of buyer-friendly pricing. So again, for any of you buyers who are believing the doom and gloom folks out there, thinking that there's going to be a crash in the market and prices are going to come crashing down, very unlikely, and you may end up paying more than what you would pay today for a property. Lake Oswego, median list price is down to just under 1.45. Price per square foot, 490. Inventory is down to 148 homes. Median days on market unchanged at 133. And our market action index has gone up slightly, so a slight seller's advantage. Lake Oswego is rich with price reductions and slow-moving listings because it is a higher price market, an ideal setup for strategic buyers. Despite a seller's market designation, motivated sellers may be open to well-prepared offers in this luxury tier. And again, don't forget that I get all this information from Altus Research, and I pull it today. So you are seeing today's numbers today. Our final local market we're going to spotlight is Beaverton. Our median list price is down slightly. It's 627,000. Price per square foot, 295. Inventory is down. It's now at 274. Median days on market is up to 70. And our market action index, which is still a slight seller's market, is unchanged at 40. So Beaverton is heating up with low inventory and increasing sales velocity. Buyers seeking value should act quickly, especially in that sub 600K tier before pricing gains traction. Again, supply and demand. Watch your feed for data for some of the other areas we follow. Moving on to our global perspective, there's 3 slides worth of information here, and we're not going to go into a lot of detail. Please feel free, go in, read it at your leisure. But just know that the global real estate market, they're at a turning point, and now's the time to scout value. So why? Key macro and market trends. Global real estate values appear to be stabilizing after a recent downturn. So just as things in the US are starting to feel like things are coming out of the doom and gloom, the same is happening across the globe. Institutional and private capital is returning to core and income producing property sectors, and opportunities exist outside of those traditional hotspots. So, may not be all the glitz and glamour, but boy, there's certainly some upsides to some of the markets, and I will show you the top markets coming up. Global macro trends support a more predictable investment horizon. So, strategic implications for US based investors. Diversifying into global real estate can reduce exposure to domestic cycles and tap markets where currency growth or yield favors foreign investors. There's definitely some countries, and we've covered a couple of them, who offer great incentives for foreign investment in real estate. Investing in income producing properties globally may offer stable cash flow while US housing remains competitive. And for investors already holding domestic properties globally, spreading risk can act as a hedge against potential US rate or price volatility. And as promised, these are the top global real estate markets to watch as we go into 2026, and some of the reasons. And there are some pretty appealing markets there. The great news is that in every single one of these, I am connected to real estate experts in those countries. So if you have any interest whatsoever, whether it's Portugal, Greece, oh my gosh, two of my favorites, Turkey, or even UAE, Dubai. Dubai is huge right now, and it is an investor's dream. If you are interested in exploring opportunities, please reach out to me, because I can put you in touch with vetted real estate experts, the majority of whom I've met with in person. We have regular communication with each other. Most of them are with our Keller Williams family, so I do meet up with them fairly regularly. So, your smart money insight and that global perspective. Global real estate is no longer just for the ultra rich or passive investors. 2025 marks a tactical entry window. Those who move decisively and build a diversified property portfolio across geographies and asset types may set themselves up for long term yield and growth, while the herd is still cautious. Again, early early bird catches the worm. It definitely applies in this case. Wealth building insight today. So this is a mindset one, and I thought that that was really important to introduce this concept, and I'll do it on a regular basis, probably once every quarter, because what we are finding is that there are many investors out there who have built up an amazing portfolio of investment properties. But you know what? Those properties are underperforming. And what we also find is that the landlords, and it may be that you just own one investment property, or maybe you own 20, maybe you own, I don't know, 200 doors, but they aren't being viewed as a true business. And then the businesses themselves are not supporting themselves. So, what do I mean by that? So, it's all about treating your investment property as a business. And it really is time to do that, because if you don't, you are leaving money on the table. So, that mindset check. Too many investors don't know how their properties are performing in today's market. They don't track cap rates or cash on cash returns. They don't have somebody in their corner making sure that they've got all this information on a regular basis. Many of the landlords that we meet with are paying for repairs out of pocket. That's not how to run a business. You really want to make sure that your business is paying for the business. And it's because there's no capex reserve planning that's been put in place. And many landlords think it's fine. The tenant pays on time. They're very complacent. They don't bug me. But most of the time, these landlords are leaving money on the table that could be there to benefit their families and grow their wealth. So, a question I like to ask, and one of the things that we do, and we'll talk about how you could request one of these, is we do an asset performance test for our investors on every single property that they own. We show them what their cap rates are. We show them what their cash on cash return looks like, and then we ask the question: would you invest in this property again now that you've seen the numbers? Because what we do find is most investors do not know what their actual yield is. They don't know if the rent that they're currently charging is market rate, or are they doing their tenant a long-term favor? Doesn't sound like a sound business strategy at all. And is your equity working for you or just sitting? So the action plan we'd like to remind all our landlord investors is think like an asset manager, not just a landlord. Track performance annually. It is essential to do that, and not just when leases end. Plan for turnover, capex, and market shifts before they happen. And this is what we do as real estate wealth advisors all day long, is we run the numbers for our clients. We come back with amazing spreadsheets. We go through them and help you understand how your property is performing in today's market. And then the decision is up to you. But your smart money insight is complacency is expensive. And if your property isn't performing, it's time for a portfolio checkup. So our call to action, I would be honored to run the numbers for you. It takes a couple of hours, but we have it all systematized. There'll be information that we request from you. We'll be checking the market rates to make sure that, where your rent is sitting in the market based on the property type, location, condition, the whole thing. And then, let us spend some time together with you going through that so you can make an informed decision about this wealth that you've been building. And for many of you, it's over many, many years of hard work and toil. And we want to make sure that your businesses are actually making the money that you expected them to. So here's my phone number, my email address, and you're going to see it again, because if today's brief spark questions or inspired a next step, I would love to connect. Call, email, put a comment in the chat, and I'd be so honored to sit down with you. We will ask you 1,000,001 questions. We'll really understand what your goals are, present all the data, present some strategies, and then the decision is up to you. So just a final disclaimer that the material is provided for general information purposes only. I am not a financial advisor, a CPA, or an attorney. We do obtain the information from very credible, trusted sources, but of course we can't guarantee the accuracy of their data. It's what we definitely use. And we're always going to advise you that when you make a decision to take action on anything, definitely consult with your own legal, financial, and tax advisor. And as your real estate wealth advisor, we actually like to earn the right to sit at the table with your financial and legal team to make sure that together we are developing the right plan to help you achieve your goals. We believe that your legacy begins with a real estate plan, and this is all the different ways that we help you develop a plan to help you achieve your goals. With that, we are at the end of our first December 2025 Midweek Market Brief. Stay warm, and I look forward to seeing you next week at the same time.